Welcome to Hedge Fund Tips with Tom Hayes. I'm Tom Hayes, and this is your 290th VideoCast podcast for the week ending May 8th, 2025. Got a lot of great stuff to cover today, but as always, family first. Let's get right down to it. This is Annabelle. We'll cover both. Mimi played in the San Diego County Cup this weekend and had some rock star goals. She plays pretty much the entire game and sprints nonstop the entire game. She only has one speed, fifth gear. They call her Wild Pony because she flies down the pool and no one can catch her, and she plows through defenders to score. Annabelle also played in the San Diego County Cup and balanced a swim meet in Irvine and the Southern California Swimming Banquet in Garden Grove, where she received an award for her national ranking. She currently leads the country in number one rankings for 10 and under girls. So congratulations. They did a rock star job. That's the banquet. This is my friend Jason Berlinger. Thank you so much. That's the 18th hole of Big Canyon again. Want to thank you for having me on. Jason's got an incredible book of business at Morgan Stanley. So those of you who need, loans for financing, stock loans, estate planning, he is a wealth manager and does a great job. Feel free to reach out and I can connect you. This is interesting. This was not far from where I live. I was walking to get dinner and look at the tires on this bicycle. This is like a beach bicycle or something. The tires say Vans. I've never seen that. I didn't know Vans was now in the tire business, but one more thing that is not priced into the stock. I don't know how serious that is, but I thought it was pretty cool. Talked to the two kids that were working in the store. They didn't know anything, of course. Then I want to thank my buddy Brad Schmidt for having me to Pelican Hill. We played the South Course, which was just absolutely incredible. Brad does commercial real estate. So if you're a big company looking to rent out commercial space, or buy or sell or rent or lease or anything in that space in Southern California, this guy is a pro. And he also does nationwide syndications, Utah, that type of thing. That's Eli, Steve. We had an unbelievable time at the Scramble. We came in negative 12 on the day, dropped a few putts, which was pretty cool. And I think negative 15 won. But I got to be honest with you, that group was in front of us, and we saw them taking a lot of mulligans. So I'm not saying, congratulations, but just saying, not saying. There's some beautiful, there's the ocean. It doesn't suck out here. I'll leave it at that. All right, then a couple goals, and we'll get down to it. So this is one of Mimi's. She gets the pass here. And she's just a beast. Boom. All right, and then last one, and we'll get down to it here. It's taking it inside. Boom. All right, rocking and rolling. So, also, wearing the t-shirt today. Thank you for all the incredible support. The key here is to get the word out. I wear this, walking by the beach and everything, and I get tons of questions all the time. I tell them about the podcast. More people we share this with, the more we're going to just keep delivering this incredible value for you guys for a very, very long time, in addition to what we do for our clients. So it's just incredible. I think what we're going to do, because we got so many more orders than we expected, and again, this is the t-shirt, by the way, very cool. And this is got my mug today. Very excited. Price is what you pay, value is what you get. And then hedge fund tips on the back with Tom Hayes. So under this, when you go to hedge fund tips, first off, click on terms. This is all opinion, not advice. Number two, when you click on number one hedge fund podcast, we're ranked by FeedSpot. And you scroll down, we talk about testimonials and merchandise, where you can get the merchandise, etc. And the testimonials. By the way, we have like 10 pages of testimonials, and we haven't even scraped them in like a year and a half. So my assistant Jennifer is going to start scraping all the testimonials off of YouTube and emails that have gone into trash over the years, and we're going to get a lot more testimonials. But what we're also going to do And not everyone's going to do this, but the ones that do, we're going to build a little hedge fund community, hedge fund tips community. And like we did with the Burden Yourself with the Facts hats, those of you who get merchandise, whether you got your mug, or you've got your hat, or you got your t-shirt, or your hoodie, or your golf shirt, and you want to send in a picture, email it to info@hedgefundtips.com, info@hedgefundtips.com. And I think what we're going to start to do over time is post some of these pictures right here before the testimonials. And hopefully over a number of years, we could have, dozens of pictures here of people from all over the world wearing their merch and showing they're part of the community. I think that would just be a lot of fun. So it's more than just anonymous handles behind the comments. You could actually see their names, and you could submit that with or without your name. That's up to you in terms of privacy, etc. So moving on. Next week, I leave tomorrow. I'll see some friends up in Connecticut, play some golf at my club there. And then on Monday morning, I'll be on Schwab Network at 8:40, NYSE Live with Kristen Scholler at 9. And then the 12 o'clock or 1 o'clock hour, I'm not sure which hour, I'll be on the whole hour on Fox Business. It's called The Big Money Show. Taylor Riggs, Brian Berenberg, Jackie DeAngelis, and Dave in for that. Then on Tuesday in the morning, sometime between 9 and 12, I will be on Varney & Co. Super excited about that. And then on Wednesday at 10 a.m. to 11 a.m., I'll be on the full hour of Yahoo Finance with Maddie over there. And also at 12:30, I'll be doing a podcast with Jared Blickery called Stocks in Translation. That won't be out for a week after that. And then 3 p.m., I cap off the 3 days of media with the incredible Liz Clayman at 3 o'clock on Wednesday. So be sure to tune in for those episodes. And then I'm off to Palm Beach to see my buddy Mike Bennett, who I know I've mentioned in the past. He's an incredible businessman, but he also wrote the book Stack and Tilt Golf with Andy Plummer. They've trained more PGA pros than you have any idea. It's always confidential, but if you ever go down to take lessons with them, you'll see 5 guys lined up behind you that you recognize on TV. So I'm going to play with him. And then we've got the meeting with the speakers down at the Money Show in Miami. I'll be speaking on 3 segments. On Friday, I'll be speaking, Saturday at around lunch, and then a private room after that. So 3 segments, and then I fly to Dubai to see my friends and clients out there. And I'm also going to meet with some of the YPO guys on my last day, and then back. So it's going to be a whirlwind, exciting May, off to an exciting start. And that's that. Now, let's get you some context for the market, because I had the privilege to go on with David Lynn. And for those of you who know, David is one of the really phenomenal interviewer, and he always pulls out the best responses from his guests, and then his audience, who are totally engaged, write all kinds of comments underneath the YouTube video. But it's just phenomenal. And we went into a lot of great stuff, and you'll see some prescience here, and you'll see some substance for what's to come. And I think you'll find it really, really valuable. So we're going to listen in here. People are saying the world is ending and they feel depressed, and then they're going out and spending like there's no tomorrow. And the question is, how does that resolve? I would not be surprised that at the end of the year, we're up 7 and 9% on the S&P 500. If we overshoot, looking at some of these historic breadth indicators, the Zweig breadth indicator has triggered, maybe we'll be up low double digits, 10, 11, 12%, but there's still tremendous opportunities.
Can the stock markets continue their momentum? Is this the beginning of the end of a bear market, or are we still in a bear market rather? We'll find out with our next guest, Thomas Hayes, managing member of Great Hill Capital. Thomas, it's always great to get a hedge fund manager's perspective on what's happening in the markets. Welcome back to the show. Good to see you.
Thanks for having me, David. Good to be here.
last time you were on the show was in January. So, wow, time flies. We got to get you on the show more often. Apologies for not following up sooner, but time just flew. So, lots happened in the last couple months, which probably was why time flew by so quickly. Let's evaluate what you told me earlier in the year. You had told me that people should watch the full-length interview down below, but I think in the beginning of the year, you were a little more cautious in 2025 than you were, let's say, the same period in 2024, last year, when you were on my show a year ago. So have things played out the way you expected to so far? Anything caught you off by surprise? Obviously, the magnitude of the tariffs caught a lot of fund managers off, but where were you and in terms of positioning on April 1st, April 2nd?
Yeah, I think, look, in early February and March, we were on public networks talking about time to buckle up, Buttercup. We're going to get some volatility. I thought we would get an 8 to 10% seasonal pullback, certainly some tariff uncertainty and that type of thing. Did I expect a 19% peak to trough drawdown on the S&P? No, but it was really an unbelievable blessing in disguise. It was certainly a man-made correction. But, one of the themes that I said in the beginning of the year, despite, to your point, we were certainly more cautious and less sanguine for 2025 than we were in 2024. I did say that our expectations were basically mid to high single-digit returns for the S&P 500, which was considered bearish at the turn of the year, by the way. Everyone was so juiced up on 2024 returns, and we're like, more subdued. And oddly enough, David, I think that's going to be on track. I would not be surprised that at the end of the year, we're up, 7 and 9% on the S&P 500. If we overshoot, looking at some of these historic breadth indicators, the Zweig breadth indicator has triggered, maybe we'll be up low double digits, 10, 11, 12%. But it's meaningfully up from here. And if you look at the average stock relative to the S&P, there's still tremendous opportunities and great things to do in this environment. But I think the key theme, David, is welcome to Trump 2.0, same as Trump 1.0. Tweet volatility resolves to the upside over time. And looking at that analog, which we were considering two during this drawdown, one was the 2018 Trump trade war 1.0, where you had a 20% correction really quickly and the market resolved to new highs within 4 months. And then we were also looking at a longer, more drawn out scenario of 2011, the European debt crisis, 20% correction, took 8 months to resolve to new highs. So we'll see which one this is. Right now, it's leaning closer to the 2018 with a higher upside, but we're going to need some more pauses in tariffs, and we do have a lot of businesses on hold waiting for more clarity. So that's not a constructive thing in the short term.
Okay, let's talk about tariffs first, and then we'll revisit your S&P 500 call that you just made. So here's from Bloomberg. Trump suggests some trade deals may come as early as this week. It could very well be, Trump told reporters on Sunday. When asked whether any trade agreements were coming this week, he didn't specify any countries. We're negotiating with many countries, but at the end of this, I'll set my own deals because I set the deal. They don't set the deal. You kept asking the same question. When will you agree? It's up to me. It's not up to them. I suppose he doesn't mean China. There's still 145% tariff on China, I believe. But anyway, I'll let you evaluate what's going on.
Yeah, look, I think the number one thing that the market needed to see, and I have to say, this was a strange correction because I had more peers, colleagues, money managers calling me in abject fear than I've ever seen in a correction. And I had clients calling me because they know these are the periods that I thrive, calling me and asking me how they could send more money in to take advantage of the opportunities. And many of them did. So very interesting scenario and consistent with what you saw in the stats, that hedge funds and CTAs were record sellers of equities, over $1 trillion at the absolute low in early April. Apparently, they were not on Truth Social when President Trump said now is a good time to buy, because that marked the low in the stock market. So the problem with that is that these quote unquote investors have been praying for a retest of the lows, and praying rarely works in investing. So every single tape bomb of a deal with India or a deal with Japan or a deal with some tiny island nation, whatever it happens to be, they are going to be forced mechanical buyers. They are upside down, and now they're just trying to stem the bleeding and the redemptions from missing, not only selling at the wrong time, but more importantly, missing the opportunity to buy at the right time. And if you look at what's happened with earnings, I mean, yes, it's rear view mirror, but with 80% of the companies reporting, you have 12.8% earnings growth compared to 6% that was expected. And estimates, yes, they've come down a little bit for 2024. They've come down about 3.5% year to date, but they bottomed about a week and a half ago at 265 for 2025 on the S&P. They're now up to 266, which tells you guidance is actually starting to improve. And for 2026, estimates have held in. So we've got a lot of back-end loaded earnings at 302, which implies an 18.5 times multiple, which is not crazy compared to a 10-year average of 18.3 times. So that's kind of where I'm thinking. The other thought that I have on tariffs, David, is that I think you wind up with a net 10% across the board, which is $300 to $400 billion. Which is great from a refinance the debt standpoint, bring down rate standpoint, spur the housing market standpoint, and improve the cost of living standpoint. That, coupled with low gas prices and a lot of other things, are a good formula. Now, if we start to see Navarro on TV every day, then we could have problems. But so far, they've kept him in the closet, and it's been mostly Bessent and a little bit of Lutnick here and there. And I think Trump is showing a lot of flexibility and rationality, which the market was unclear whether that was going to be coming following Liberation Day.
You said to Reuters, and I'll pull up this quote from actually your website, Hedge Fund Tips. You extracted this. I do think that what today is saying is that the economy is a lot stronger than what people thought, and a lot more resilient in the face of all these tariffs and fears about tariffs. Which signals or indicators signal to you resilience, Thomas?
I think earnings and guidance are the name of the game. I think when you look at the negative GDP print, I think that was a good wake-up call for the administration. The bad news is you got a negative GDP print, and like 2022, if you get 2 quarters in a row of negative GDP prints, you have a technical recession. And I believe we had a recession in 2022, even though the council did not define it as such. All the activity and all of the results were consistent with the recession. So I think it was a wake-up call like, hey, you are threading this needle. You're trying to cut this money on Doge. You're trying to balance the budget, et cetera. If you tip into a recession, it's going to cost you way more to bring us out of a recession in terms of lost revenue, in terms of stimulus, than it would be to just do nothing. So your Doge cuts will be in vain. All of the fiscal constraints and layoffs will have been in vain if you tip into recession. So while the negative 30 basis points print for Q1 GDP was not the clearest, because if you back out the inventory building and the reduction of government spending, you're at plus 3% GDP. So it's not what you would normally see in a negative print. It still is a negative print. And I can assure you the administration does not want to see 2 consecutive quarters of negative prints, because that is a technical recession and that creates all kinds of problems. So they immediately did an about face. They, paused the tariffs, showed flexibility with the auto industry, showed flexibility with negotiating deals with counterparties. So I think in that sense, it was a wake-up call. I think they're going to wind up with, it will look like they're blinking on these deals, but at the end of the day, they're going to wind up with $300 to $400 billion of tariff revenue. And if they had started with a 10% ask. We'd be lucky if we got 30 or 40. So they asked for the world. They wound up with something bigger than anyone could have ever imagined. And it keeps the train on the tracks. It doesn't, the light at the end of the tunnel is not an oncoming train, which people were worried about in early April. It's actually the end of the tunnel.
What are you expecting consumer sentiment or consumer demand to do for the next quarter? I'll give you some examples. So earlier in the year, we had data come in that advanced retail sales continued to grind higher. A lot of that came from actually trucks and cars, new and old. People were just buying them before the new tariff prices kicked in. Do you expect that trend to continue? Do you expect strength to continue at all?
I do. I think, look, you never bet against the U.S. consumer when they have a job. And we saw the jobs report. We saw the unemployment rate stay at 4.2%. Non-farm payrolls came in better than expected. There's an interesting dichotomy right now between the hard data and the soft data, what people say they feel and what they actually do. People are saying the world is ending and they feel depressed, and then they're going out and spending like there's no tomorrow. The question is, how does that resolve? Does their sentiment start to improve consistent with their actions as more deals are announced? Or does their actions start to catch up to their sentiment, which is what the bears are worried about if this thing drags out longer? There was someone on Twitter today saying the next step should be a 180-day pause. Maybe we'll see something like that if they don't get a deal announced this week. But I think that now the American public is seeing some rationality and not rigidity on behalf of the administration. We're going to get more than we would have gotten, but we're not going to blow up the world to do it and create a depression or a recession. I think people's sentiment will improve. And the thing about the cars, it's a lot of different things coming together at once. Number one, dealer incentives are going up. I know this industry like the back of my hand because our largest position is an auto parts supplier, which I've talked to your audience about, called Cooper Standard, which was up 43% on Friday and probably another few percent today. They supply the sealing systems around the windows and doors and the fluid transfer systems for new automobiles, predominantly to U.S. OEMs. And the big deal there, what we've been watching, it's a play on the volume recovery, which troughed at 15.2 million SAR. We expect it to get to normalized levels like it has every cycle for the last 40 years of 17.5 to 18 million SAR. They make money on that volume. There are a couple of things. First and foremost is the average car on the road is 13.5 years. So yeah, they're going to continue to buy. Number two, dealer incentives are going up. They had this cartel during COVID that they really took advantage of people selling above MSRP, and they kept that game going afterwards, saying our supply is limited, our supply is limited. And that gig is up. So now it's going to be a race to the bottom for OEMs. They're going to put out massive volumes across the board, and they're going to compete on price and incentives, which means volumes are going to go up. And just like generators, when your neighbor has them and they're watching TV while you're sitting in the dark during a power outage, you get one the next time. It's the same with new cars. There haven't been a lot of new cars. As your neighbors start to get them, you're going to get them. And with incentives and with rates coming down, Betson's going to bring down that 10-year yield by eliminating some bank charges and deregulation on that front. I think a lot of good things are going to happen with consumer spending. And I think a lot of it is going to be concentrated in the automobile industry because it's needed. 13.5 years is the oldest the fleet has ever been. And we have 72 some odd millennials that need cars, starting new families, moving out to the suburbs, et cetera.
Yeah, I wonder what that's going to do to the auto industry. Just let us know. We'll move on. Clearing inventory. I just happened to have walked into a Tesla dealership yesterday. Yeah. While I was waiting for something else. And they told me that they have the inventory prices for their models in inventory, and then they have the tariff prices if you order online. That's going to come in that's like 20 grand more for every model, which is a big number for Canada. So
yeah, that sounds like a sales pitch. They won't get away with that because there's so much supply that's coming on, and then everyone that's worried about, oh, this was a one-time pull forward. Well, they're going to now have to replenish those inventories, and all the manufacturers are going to be doing it, which is going to create a lot of supply and a lot of incentives. So, Tesla, if Tesla believes that, they're going to get a rude awakening call as they bring prices down in coming months.
This is why we should go shopping with Tom Hayes. But Tom, tell us about the FOMC. We're expecting a no action from the FOMC. Well, that's what the markets are expecting for this week. What's happening for the rest of the year? How many rate cuts are we expecting, if any? Are you expecting?
Yeah, it's interesting. We saw last week we saw negative GDP. We saw the PCE come in the lowest it's been, which is the Fed favored number, lowest it's been since November. So those were the two pieces. But what have they been talking about? Waller and the Cleveland governor, they've all been saying we're watching the labor market. So we saw the ADP was weak, and we're like, okay, if the jobs number is weak, the Fed could move, soon. Jobs number was very strong. So it might be a little bit backward looking, but certainly 100% takes May off the table. June is, was at 65% odds. It's probably a little lower now. I'd say June is a coin flip. I still am of the camp we're getting to before the end of the year.
Your overall tone reminds me of Warren Buffett's speech over the weekend when he announced his retirement.
The time has arrived where Greg should become the chief executive officer of the company at year end, and I want to spring that on the directors effectively and then give that as my recommendation.
He said he was very lucky to have been born in America. I'm paraphrasing here, but we should continue to invest in America. And long term, he's very bullish on the prospects of capitalism in America. I'm guessing you largely agree, but how do we make that an investment thesis here?
Yeah, look, Buffett is my hero. I learned so much from him and Charlie over the years. It's shaped a lot of who I am. Obviously, I have my own special sauce turnaround, Tom. I like more turnarounds, more of what Buffett was doing when he was running outside money the first 12 years than what he did during Berkshire. Look, U.S. exceptionalism will never change. And the reason that will never change is because of immigration. I mean, that's fundamentally what it comes down to. Is we've had the best ideas and the best minds and the risk takers from around the world who took a chance and came to America. And it's this repository of the best of everything in the world in one place, plus natural resources, plus good defense borders. So that's never going to change. Now, does that mean U.S. equities have to outperform because America is so great? No. If you are willing to look past a little recency bias of the last decade, you'll see that every 10 to 15 years, you run in cycles where dollar is strong and U.S. equities outperform, which is what you've seen in the zero interest rate policy period post Great Financial Crisis, plus a few extra years. But then if you look back, even during Reagan, there was a big period there that international equities outperformed U.S. Not because U.S. wasn't great, not because Reagan's policies were bad or the rest of the world got better than the U.S. It's just a normal cycle. Some of it has to do with U.S. dollar currency. Some of it has to do with earnings power. But it is a regular cycle every 10 to 15 years. International outperforms U.S., then U.S. outperforms international. And I do think we are on the cusp where we're going into, and have already started actually, a period where international equities outperform. And that could simply be a function of multiples as Mag 7 have been more subdued and their weighting starts to normalize in the S&P 500. The index's weights and composition may start to look a bit closer to international. And then you've got some earnings growth in some international pockets, which is really exciting, like China tech, et cetera, that could start to take up some of the weight in the international indices and then the institutional flows. And it's a flywheel, as more money goes in, the multiples go up, which creates more flow, which is what the U.S. has benefited from for the last 15 years. And I think we're probably going to moderate relative returns, even though we'll have good returns, we'll moderate relative returns. And I think the outperformers are going to be the ones that have exposure to international in the next 10 years.
That was my next question. If not the U.S. equities, where should we go for outperformance?
Well, look, I talked about Cooper Standard, which was a U.S. company. We have a huge position in. We've had a huge position in Alibaba. I mean, and that's been, a couple years in waiting. Every red day, we've been buying stock, and it's now rallied, and we've got a average basis across all accounts of about $83. We think that's just getting started. Now we've got the problem that you got all these politicians that say, let's torch U.S. investors and delist it, and cost U.S. investors $800 billion, which would be the dumbest political move of all time, to torch. It doesn't hurt China to delist Chinese companies. It's not Chinese investors that are buying U.S. ADRs. It only hurts U.S. investors. So we've shifted all of our equity exposure to Hong Kong holdings just in case stupid political decisions are made. But we still do own some derivative exposure in the U.S., and we'll just absorb that risk because we can't replicate it in Hong Kong. But the bulk of our allocation is now held in Hong Kong shares just to hedge out that delisting risk, which I think was more acute a couple of years ago when it ultimately came through with flying colors through the PCAOB. And I'm sure this is probably some part of the negotiating leverage with China. Come to the table and do a deal, or we will take away your access to U.S. capital markets. And it's being fostered by a couple of actors like Rick Scott and others who are the headline grabbers for the negotiating leverage with China. But I think when all is said and done, I'd assign maybe it's a lot less than a coin flip odds of delisting. I'd say it's probably 20% because it only hurts us. I think if they really were sincere about it, what they would do is say, we're not going to screw the U.S. investor. What's listed here is going to stay listed here, but we are closing the door to any new offerings in the U.S. prospectively. That would be like a sincere play where I'd be more concerned if that was the case, because that would tell me that they've actually thought it through. It wasn't just an anti-China sentiment. And if they had thought it through and then they cut off capital markets, I mean, all that effectively happens is you take billions of dollars of fees that go to U.S. banks and you push them out to London and you push them out to Hong Kong exchanges, which again hurts the U.S. more than it hurts China. But if that's the direction they take policy, we've hedged, because what they can't do by delisting them is change the earnings power of an Alibaba or a Tencent, and the free cash flow they generate and the amount of shares that they buy back. And the number one AI play in the world right now, their Qwen 2.5 is outperforming DeepSeek, it's outperforming ChatGPT, and they own an equity stake in pretty much every AI startup in China because they give them cloud computing services. They're number one in cloud computing in exchange for equity in their companies. So there's a lot of outs, like we like to say in poker, by owning Alibaba. You got the number one toll taker, as the Chinese government wants to move the Chinese economy to 70% consumption over the next 10 years. Alibaba will get 40 cents on every dollar as a toll taker goes through Alibaba. And a lot of positive things happening. So China, certainly opportunities in beating down Europe, emerging markets, et cetera. So there are a lot of things to do, and there are a lot of things to do in the U.S. If you're not in the indices and you're not in the most crowded trades, there are a lot of companies that are still very undervalued.
Are you ready to meet the biggest minds in Bitcoin face to face? Well, this summer, the crypto capital of the world isn't Silicon Valley or New York or even Miami. It's Las Vegas. Introducing Bitcoin Vegas, the ultimate Bitcoin event of 2025. And this is not your average conference. Join real conversations with people shaping the future of money. Thought leaders like Michael Saylor, Lynn Alden, Ross Ulbricht, Winklevoss twins, David Sachs, and many, many more. Whether you're a hodler, builder, or just Bitcoin curious, BTC Vegas is where ideas ignite, partnerships form, and conviction grows in the space. Tickets are going fast, so lock in your spot today using my link down below or scan the QR code here. You'll get a 10% discount. Get it before tickets are sold out completely. We'll see you in Vegas. Are you betting on the Chinese economy when you're investing in Hong Kong equities at all? Are you exposed to Chinese growth? For example, I was reading just now, China's exports rose 6.9% in Q1 2025, despite the ongoing trade wars with the U.S. Chinese officials recently said the sky won't fall for China's exports, especially since they're diverting a lot of their U.S.-bound exports to other countries in Southeast Asia and perhaps domestic consumers. So what's your take on Chinese growth here?
100%. It's a de minimis portion. Like it's almost, I think if the apocalypse happened and there was a U.S. embargo on Chinese goods, I think it would affect Chinese GDP by 1 to 1.5%. So, they've kind of been preparing for this. Number one. Number two, they already devalued the yuan by like 20%. So it's like, oh, you want to tariff us 20%? We've already priced that in. So thank you very much. If you want to do a deal, we'll appreciate the yuan. So it's kind of silly season, and I understand why they're doing it. And by the way, there's a deal to be done, because the U.S., if you look at the percentage of manufacturing versus consumption in China versus the percentage of manufacturing versus consumption in the U.S., it's like a 20-point spread. And they just basically want to meet in the middle. If we got 10 more points of manufacturing and they got 10 more points of consumption, it's a win for both countries. So they're going to do a deal. There's probably no delisting. If they don't do a deal, it hurts their GDP 1.5%, and they'll just amp up the stimulus, which helps companies like Alibaba. Am I making a bet on China, China's economy? Implicitly, yes, but Alibaba got so undervalued as a sum of the parts. I mean, between the number one cloud provider, number one retailer to the middle class. So as their economy is recovering and the stimulus has kicked in, they're just so, the demand for compute power and AI and everything going on with Alibaba, there's just nothing like it in the world, where price is what you pay, value is what you get, quoting Warren Buffett, that you could have done this. And yeah, it's up a bunch from where we own it, but I think it's just getting started. So irrespective of whether they do a good deal or a bad deal, obviously I'd prefer a good deal that makes sense for both parties. And I think President Trump wants a good deal for both parties. He's more of a pragmatist than an idealist, and that's started to come out in recent weeks. But if you read all his books, he always starts with punch you in the face first and then offer you an ice pack. And that's how he gets to a final deal. So...
All right. Well, so Hong Kong equities, what about other asset classes? Are you diversified across other asset classes outside of equities as a hedge?
We're an equity manager. So we run a concentrated equity portfolio with derivative overlay for family offices and ultra high net worth individuals.
I see.
So
I guess not.
So the answer is no. But I could see a scenario where... So we would express it through equities. Materials have been left for dead. I think there are some commodity plays to be had. We have had a view when it was unpopular that the dollar was going to continue to weaken. Now that everyone is kind of in that boat, we probably get a counter trend bounce in the short term, and then resume the intermediate downtrend a few months out. But when you see it on the cover of The Economist and Barron's at end of the dollar, it's like, all right, so now we're going to get a bounce. So I definitely like materials. I like some commodity plays. I'm trying to figure out how to get more exposure to energy. We've got a big position in Comstock Resources from just below $9. It's up a lot. It's a natural gas play on the Haynesville. Jerry Jones, the owner of the Cowboys, owns 66% of that. So we're trying to figure out maybe oil servicers, try not to play the price of oil, but just the volume, kind of like what we did with the auto industry. We don't want to be in the OEMs, the car manufacturers. We want to be in the arms dealers, the suppliers. Let the car manufacturers duke it out, race to the bottom in terms of margins, and let the suppliers benefit from volume. I think that's going to be the case with, natural gas is a covert play on AI demand. And compute demand, running the data centers. We need unlimited amounts of energy, and I think natural gas is going to be the transition. So there's a lot to do there as well.
Interesting. Final question, since you brought up what people are feeling, what is the prevailing sentiment in the equities markets right now? We've had a bit of a rebound, as I mentioned in the beginning. We talked about this. Is it still one of fear and uncertainty, or are people a little more bullish now in May?
If you look at the sentiment indicators and you look at the positioning, yes, VIX has come down. Yes, you've had the breath thrust. I think people are still skeptical, and I think there are a lot of bears that are angry and are praying to God that they see a retest of the lows. And my guess is we'll get a couple of deals and maybe consolidate, get a few percent pullback in coming weeks, and the bears will think that they're on track and it's going to go back and retest, and then we push higher and higher, because the earnings and the guidance, I mean, the fact that we can have this level of guidance and still looking at $302 of earnings in 2026, despite knowing all of this chaos, is telling me that, God forbid we get any good news, the pent-up demand. I mean, I see it and feel it just in my daily life at the restaurants, at, shopping, at the malls, et cetera, travel. I mean, people don't seem to have a care in the world from what I can see. I certainly hear it in the conference calls at the very lower end. There is some strain, et cetera, and we understand that. But to circle back, people still have jobs, and when people have jobs in America, they tend to spend. Excellent.
Well, let's see what happens later in the year. Your track record on my show has been pretty impeccable so far. So if you're bullish, then we should probably look at that as a signal. I'm just wondering whether or not, to my previous question, I'm just wondering whether or not there was a strong sentiment that we can play as a counter trend, but it seems like people are kind of on the fence right now. Yeah.
I think, the extreme that was a no-brainer was in early April. And we were kind of identifying that on our podcast. I think at this point, the bears know they're screwed, so they're just praying for a second bite at the apple to be able to buy at new lows. And the bulls that, usually what happens is everyone probably bought up on Thursday and Friday after 8-9 days up. And so those people need to get punished. So my guess is you'll see some short-term volatility in the coming weeks, maybe a few percent pullback just to hurt the Johnny-come-latelys. And then when the bears think they're back in control, we rip higher. And that would be consistent with what we saw in the 2018 recovery in Trump 1.0. So look, those are best guesses. I mean, at the end of the day, I just like to look at companies, and what I did on I did a call on April 7th for my clients, and we went through company by company, just the free cash flow and the balance sheet. And we're like, look, the worst case scenario can happen. These things are priced for that. And if you get any possible good news, we're going to have the most incredible few months we've ever seen. And that's been the case in the last few weeks. It's been insane to the upside. And fortunately, I have really incredibly smart clients who were sending in a ton of money at the lows to buy stocks versus the opposite. So very grateful on that front. And, we take it week by week. As the facts change, we adjust our viewpoint. But on balance, what we said in the beginning of the year, I think is going to hold true. I like the high single digits upside for the S&P 500, and maybe a little more if we get a lot of good news. But it'll be some bumps between now and then to get there, and just use those as opportunities.
All right, perfect. Thank you. Where can we follow you, Thomas?
On X, Twitter, I'm at Hedge Fund Tips. On TikTok, a huge following at Official Hedge Fund Tips. Same on Instagram at Official Hedge Fund Tips. And then our podcast is Hedge Fund Tips with Tom Hayes. It's #1 in the hedge fund category. You can find it on YouTube or anywhere you get your podcasts.
Okay, excellent. We'll put the links down below, so check that out. Thomas has an excellent podcast. Take a listen. So we'll speak again next time. See you. Take care.
Thanks so much, David.
Thank you for watching. Don't forget to like and subscribe.
And we're back. So thanks to David Lynn for that. Also want to thank, had a chance to talk to Andrea Heng and Haryanto Damon about Warren Buffett's retiring and the future of Berkshire Hathaway. I know a lot of you own Berkshire Hathaway stock, so I gave some thoughts on how I'm thinking about that, and you can listen in here.
Open for business on CNA 938.
Berkshire Hathaway held its annual shareholder meeting in Omaha, Nebraska, and its CEO Warren Buffett picked the very final minute of that gathering to drop a bombshell. The Oracle of Omaha is stepping down. Well, it was an anticipated announcement from the 94-year-old. He is 94. But the news still came as a surprise to shareholders who were present and even to his own hand-picked successor, Greg Abel. He's not only the savviest investor of our time, Mr. Buffett, but he also built Berkshire Hathaway from a failing business into a $1 trillion company today.
Under him, Berkshire's annualized shareholder return has roughly doubled that of the S&P 500. Now, the company has close to 200 businesses, including Geico Car Insurance, the BNSF Railroad, industrial and chemical companies, utilities, and even the Dairy Queen ice cream. So what will Berkshire Hathaway look like without Warren Buffett? Well, let's get the thoughts of Thomas Hayes, Chairman and Managing Member at Great Hill Capital. Thomas, thank you for setting aside time to speak with us this morning on Open for Business. We have to ask you first, did the announcement come as a shock to you, even though we all knew he'd step down at some point?
Yeah, we just didn't think he would be stepping down vertically. We thought it would be when he was horizontal. So I think it was quite a bit of a surprise for everyone. Absolutely the greatest investor in the world of all time. And to your point, 5.5 million% return since 1965 versus the S&P of 40,000, give or take. In English, that just means he did about 19.9% per year for 60 years, and the S&P did 10.4. And it was less the great decisions that he made than the big problems he avoided. You know, I remember the covers of Forbes and other magazines in 1999 and 2000 when they all asked, did Warren Buffett lose his touch because he wasn't investing in tech stocks and he was buying all these value stocks and these boring companies? And then the next couple of years came when the NASDAQ fell some 80-90%, and Buffett was up for the next 3-4 years and laughing all the way to the bank. But that's Warren, and he never took victory laps. He just let his actions speak for themselves.
So obviously you're a big fan of Warren Buffett. I mean, no surprises there. I am as well. How did you react, though, when he announced Greg Abel as his successor?
Well, listen, Greg is an incredible business operator, but, you know, it's kind of like Taylor Swift and her band. When Taylor steps down, how many people are going to show up to watch the band? I mean, he's built an incredible conglomerate. It's a very solid, rock solid business, but without Warren, it kind of loses that magic touch. And I would estimate on a go forward basis, you're effectively got a compilation of businesses like Haryanto was referring to, 180 some businesses. It kind of represents the S&P 500. Unless you saw some transformative or see some transformative deal to sop up some of that $350 billion of cash before he passes. Once he does pass, I think there's going to be a lot of noise to start to issue dividends, to break up the company, some of the parts. They won't do that because he's probably taken every possible action he can to prevent them from doing that. But that's really going to be the story. And without the Apple investment, the performance the last 20 years, because the law of large numbers, was a lot more muted than obviously the first 40 years before that. And that's just by nature, $1.1 trillion business now, $350 billion of cash. It's going to be much harder to move the needle and have that level of outperformance moving forward. And the one thing that no one's been talking about this weekend, Andrea and Haryanto, is one of the huge moneymakers besides Warren's stock and business picking ability was Ajit's underwriting ability. And Ajit is getting up there in age. And he was responsible for creating all that free investment float from the insurance premium. And he will be very, very, very difficult to replicate as well. I mean, Buffett had joked over the years, if you have a choice, kind of if there's a safety raft on a boat and one person can fit, make sure you put Ajit in the raft and leave me on the sinking ship, because Ajit has been a major, major moneymaker over the decade.
Thomas, Berkshire without Buffett is a theme that's going around because that's just how synonymous the two are. Some investors, they worry about the future of the company without the Buffett magic through Greg Abel. What will Berkshire's board, as well as Mr. Buffett and Mr. Abel, need to do to, I suppose, convince investors that the company is in safe hands?
Well, look, I think Greg Abel is a competent operator. Todd and Ted at the investment wheel. We didn't really get they weren't brought out to the forefront as much. So I think investors don't really know what to think of their investment ability. Obviously, Buffett has huge confidence in them, or they wouldn't be in that position, and they wouldn't have continued in that position. And they're very smart investors. But the Buffett magic touch is a whole different story. And I think in order to move the needle beyond basically being a proxy for the S&P 500 post-Buffett, a real transformative business deal needs to be done before Buffett passes. And you look at the ones that they've done in the past, whether it was Mid-American Energy in 2000, they paid $2 billion. That's where they got Greg Abel from. Or Burlington Northern Santa Fe Railroad in 2010, he bought that for $26 billion. They really need a needle mover to kind of give investors the idea that this can continue to have outperformance, because that 2% outperformance for the last decade, which is very impressive, was largely attributed to the investment in Apple. So they're really going to need something like that. Otherwise, you just have to accept it's a $1.1 trillion company, hard to grow at 20% a year at that level, and just effectively, take a choice, whether it's the S&P or Berkshire. You're probably going to get similar type of returns over the next decade.
Well, Buffett seems to think that Abel has what it takes to get there, or even take Berkshire Hathaway even beyond that. But the thing is, he's also inheriting the company at a really tough time in the American economy, so to speak, with Mr. Trump and his tariff policies, among many other things that are weighing on Americans right now. How will his challenges differ from that of Warren Buffett's, say? I mean, it's hard to beat. Like you say, 60 years of returns at 20% or more. I mean, it's going to be a tough call for Mr. Abel, given the current environment he's in, do you think?
Well, look, I mean, if your boss set you up with $350 billion of cash, you'd have to work really hard to screw it up. He's got an awful lot of cushion and awful lot of optionality to make good things happen. And I think he's certainly a competent operator. As it relates to tough times in the U.S., I think that's a very difficult statement to justify based on the numbers presently. We just came off earnings season. We had 12.8% earnings growth. The negative GDP headline that people are referencing was a lot of pull forward from imports, C plus I plus G plus X being net exports. That took off about 3 percentage points. So barring that pull forward, we basically had 3% economic growth. Now, if we go another 2-3 months with no reasonable trade deals, then we could potentially have a problem. And honestly, given Berkshire's cash position, that would be the best thing ever that could happen to Berkshire. But I really don't foresee it happening. That what we've seen so far is we have a Trump put. They've shown flexibility to pause. They've shown flexibility with different industries, the auto industry, to do certain carve-outs for the auto suppliers. And the rigidity that started with quote unquote Liberation Day has kind of ameliorated. So that's given the market some level of comfort. Earnings guidance, while it's come down about 3.6% for 2025, it's held in for 2026 at $302 on the S&P, which implies we're trading at about 18.5 times next year's earnings compared to the 10-year average of 18.3 times. So the economy is generally strong, which is kind of their problem. Unless things get really bad, they're going to have a hard time finding a big enough business to buy to move the needle at good prices. And that's been the problem for a long time. much easier to find smaller subscale businesses when you're running 10 or 20 or 30 billion dollars than when you got a 1.1 trillion dollar company. So the days of the little one-offs like See's Candy and Dairy Queen and the gas stations and Hellsberg Diamonds and Omaha Furniture Mart are behind them. They really need something big, and you know, it's hard to say that that's in the immediate future.
Yeah, he's got not just big shoes to fill, but a pretty challenging front to tackle as well. Thomas, we'll leave it there. It's the end of an era, start of a new one, hopefully, for Berkshire Hathaway. Thomas, it's been great to have you to chat with us this morning. Really appreciate it, and surely not going to be our last one with you.
Thank you very much, Andrea. I appreciate it, and Haryanto as well.
That's Thomas Hayes. He's chairman and managing member at Great Hill Capital.
And we're back. And then finally, this one was all the way last Thursday when we...
And to break down these results, we have Thomas Hayes, chairman and managing member at Great Hill Capital. Thomas, thanks for your time today. So let's start with Microsoft, because the initial concern was that there was a slowdown when it came to data center leases, but that's not what we saw. We're seeing increased spending, in fact, increased demand for its cloud division. Does this put concerns of overspending, overinvestment, and even slowing AI demand behind us?
Well, they absolutely crushed earnings, Sarah. And to your point, they raised revenue guidance by $1.25 billion. They're expecting Azure growth, the cloud growth of 34 to 35% after hitting 33% this quarter. So all the concerns and all the rumors about leases being canceled, et cetera, were in vain. Revenues were up 13% versus 8% expectations. Earnings were up 18% versus 10% expectations, and guidance was strong. So this is in line with what we're seeing so far in earnings season, which is earnings are up 10.1%. And that's why when we saw the Atlanta GDP now had been predicting negative 2.7% GDP, we thought it was a little bit ridiculous. I mean, GDP did come in at negative 0.3%, but as you referenced, Sarah, that was mostly due to inventory building ahead of tariffs. X that inventory building, we would have had positive GDP growth of about 3%.
Yeah, we'll get to the GDP more in a bit, but I want to get to Meta as well, because they posted strong advertising revenue, and that's despite concerns over tariffs and what these tariffs can do when it comes to corporate spending. What does that earnings results tell us about the potential drag that tariff uncertainty and volatility would have in the corporate sector?
Yeah, well, the ad revenue was the big question mark. People were a little worried about consumer sentiment, et cetera. Came in $41.3 billion of revenue versus $40.4 billion estimated. Unlike Microsoft, which raised revenue guidance, Meta's guidance was in line with expectations. And some of that is due to the fact that 10% of their ad revenue comes from Chinese sellers in the U.S., and that's probably going to go away a little bit in the second quarter. So they had to take that guidance down. But overall, very solid on the daily active users, 3.43 billion versus 3.39 billion estimates. So all in all, I mean, earnings 6.43 versus $5.24 estimate, revenues 42.3 billion versus 41.4. Really, really good, and alleviated a lot of fears in the market. And I think you're going to see some follow through with this positivity after market.
Yeah, and we briefly talked about GDP. They're shrinking for the first quarter, and there are now concerns about stagflation, of course. President Trump blaming it on his predecessor. Some analysts are attributing this to front loading. But what do you think about the numbers, and what does this tell us about the path ahead for the U.S. economy?
Well, I think the negative is a positive in the sense that it brings in three puts on the market. Number one, you have the Trump put. On April 8th, he said, now's the time to buy the market. That was the bottom of the market that day. Today, he came out and said, be patient. America will boom. So, you know, Trump is now watching the markets. Then you have these three numbers that were weak today. The GDP was weak. The ADP job numbers, 62K versus 120K, was weak. And inflation came in the lowest since November, the PCE prices at 2.3%. So those three things bring back in the Fed put, and we're now pricing in about a 65% chance of a cut in June. And then the final put was the Treasury came out with an announcement that they're looking to enhance their Treasury buyback program to lower long-term lending costs, i.e., bring down the yield on the long end of the Treasury curve. And that is very, very constructive for the economy. So what's bad is good. Our earnings have been very, very solid. Guidance has been pretty good. These economic numbers bring the Fed back into play. And the most important thing will be the jobs report on Friday to see how that labor market is doing and how quickly the Fed is going to step in.
Yeah, so now it sounds like you are waiting for more support from the Fed and the Treasury. Thomas, will that be enough, though, to carry the U.S. markets higher forward, even with this backdrop of uncertainty and volatility? How much room do you think Wall Street can go higher from here?
Okay, so what we had on April 8th and April 9th was record selling at the lowest point when the market was down 19% by hedge funds and CTAs. What's basically happened is we've had this rebound, about halfway rebound. They are praying for a retest of those lows, and praying rarely works when it comes to investing. So as the market pushes higher, maybe it's going to be more earnings, but I think it's going to be deal announcements, trade deal announcements. All of these people that got short at the exact wrong time are going to be forced buyers in coming weeks as we get deal announcements. And that's going to probably be the surprise of coming weeks, is that while everyone's skeptical and some of the economic numbers are slowing a bit, is that you have forced buyers who basically sold at the exact wrong time that are going to have to get in and chase once we get some positive news across the tape as it relates to trade deals.
Yeah, and we'll watch that closely when it happens. Thomas, appreciate it. And now this is Today. Thomas Hayes there, Chairman and Managing Member at Great Hill Capital.
Talking about earnings, but the most important part of this, even if you want to fast forward, is the last minute and a half when I was talking about forced buyers, and that proved to be really prescient, especially considering what happened today. So listen in here. And we're back. And on that one, just want to thank Audrey Tay and Sarah Al-Khaldi for having me on that. Reuters want to thank them for including me in their article here last week about the stock market. And then on to our quotes of the week. We had Warren Buffett here. You do things when the opportunities come along. I've had periods in my life when I've had a bundle of ideas come along and I've had long dry spells. If I get an idea next week, I'll do something. If not, I won't do a damn thing. And this is what Buffett calls the no strikes rule. You can stand at the plate. In baseball, they call strikes if you stand there and do nothing. In investing, they can throw it down the middle. You don't have to swing. You can wait till the very fattest knuckleball that you can knock out of the park. And that's what we try to do here. And we learned that from the master himself, a hero to me, Warren Buffett. Seth Klarman, value investing requires a great deal of hard work, unusually strict discipline, and a long-term investment horizon. Few are willing and able to devote sufficient time and effort to become value investors, and only a fraction of those have the proper mindset to succeed. That's from Seth Klarman. It's interesting. People are asking me like, wow, you must be so excited about Cooper Standard. I got to be honest with you. I was more excited about Cooper Standard when I was buying it in the low fives in May of 2022 than I am today, because I knew that what you're seeing today was going to be happening, whether it took 2 years, 3 years, 4 years, 5 years. So yes, it's a five-bagger off our initial basis so far. We believe it's just getting started. It's only crediting at this stage. It's giving you credit for, under $2 of earnings, getting ahead of itself. We think that if the execution goes right and what we heard about the tariffs and everything else, not only can it match what it did in 2017, earning $7.19 a share, but we also think that because of all the costs that they've taken out of the business, that it could potentially earn more this cycle. So there's a lot of gas in the tank. You can manage your position as it continues to go up, but for me, honestly, the red days when I got to buy more were far more exciting than seeing happen what we knew was going to happen before we entered the position, and more good things to come. So very grateful for that. Next, my idea of a great business is one that has a shortage of competitors. Peter Lynch, that's what I was worried about with the tariffs. I'm like, who's going to stand up the $1 billion factory to replace Cooper Standard if they get destroyed because of tariffs? Like, think about this, guys. It's about share. Everyone's going to have to deal with the same set of conditions, and the underlying demand for the cars is not going to change 13 years, et cetera, et cetera. We've covered it all. Moving along, let's go through some data and charts. We've got a ton of them this week. First off, consumer balance sheet. You can see that, by the way, this is from one of the major banks through Seth Golden, posted it on his website, on his Twitter. You can see all the assets that the consumer balance sheet has, 190 trillion versus the liabilities at 20 trillion. So you can see that they are very, very well capitalized. And this creates a lot of space as Besant gets the 10-year yield down and people can start to draw on that equity, home equity lines again. You're going to see massive, massive consumer opportunities with cars, with houses, with everything else. Average S&P stock trades at an extreme discount to the cap-weighted S&P 500 index. All this says in English is there's so much to do right here. Yes, a lot of our stocks have taken off. Look, I love Boeing. Boeing's up 50% in a couple of weeks and no one's paying attention. Those are the best movers when no one's paying attention after it's moved so much because it got so hated and forgotten. I mean, I was pounding the table on Varney for weeks. Disney, same thing. They just beat, it's starting to fly again. These are the best ones when they fly and no one cares about it. And we're seeing more and more of that. So that's that. Here is the Qwen model versus OpenAI, DeepSeek, Grok 3, Gemini 2.5, OpenAI, all the versions. And you can see that Qwen, Alibaba's AI models, blow the doors off OpenAI, DeepSeek, Grok, and Gemini on every single metric. It's not even a competition. It's like putting up a McLaren against a Miata. It's like no one even needs to go to the race. You know what the outcome's going to be. Average home, and I continue to say, cheapest AI play in the world. To reiterate, as we have for the last 8 consecutive weeks, we now own 100% of our stock in Hong Kong, ticker 9988. Not because we think the administration is going to torch $800 billion of investment capital. That would be far too stupid for any rational administration to do. But just in case, it happens, we're covered. We still have derivative exposure in the U.S. and we're 100% willing to take 100% of that risk because we can't replicate it. And any derivative position we go into, we're willing to take that because the expected value is so high and it's positioned accordingly, et cetera. So there's still risk on the derivative side. We can live with that anyway because the equities will appreciate well more to compensate. So, and we think, again, it's a low probability. We go through this song and dance every 2 years. Average home builder incentive as a percentage of sales price. Just like cars, as incentives go up, so do volumes. The same thing is happening. Biggest 4-week VIX declines and forward S&P 500 returns. So you can see we've had a huge VIX crush, which we talked about a few weeks ago on Varney. And you can see the average return going out. 1 year is 16%, 3 years is 46, 5 years is 85, et cetera. 20 worst shipping quarters. We just had one in Q1. That should start to free up as more of these deals get announced, like the UK deal today. Share of accounts making minimum credit card payments rising. So we did acknowledge this in one of the interviews that you are seeing some pressure at the lower end. But you have to keep in mind, people still have jobs. So when consumers have jobs, they spend. And part of this is a function of rates. They got all this debt taken out in 2021 when rates were basically zero. So the banks are going to have to eat some of that. It's just the way it goes. United States international arrivals is tanking. That's tourism on the basis of what's happened. That will rebound very, very quickly as deals get signed. I can already see the Brits getting on the airplane to come visit New York. So that's that. And as the dollar weakens, you are going to see an absolute unbelievable abundance of tourism in the United States as the dollar continues to weaken. U.S. real personal consumption expenditures. Bad data is bad news. Dismal years for stocks. All right, so this is trying to make a bear case, except it's already happened, so it's rear view mirror looking. Dollar remains overvalued on a long-term valuation metrics. That is correct. We do believe the dollar is going to trend down for some time. However, because everyone's getting bearish on the dollar now, and you saw the covers of The Economist and Barron's, etc., we do think you get a counter trend bounce in the short term, just enough to force covering for the people who got short late. Hedge funds have gotten very short late after a huge move, that once they get punished, it'll resume the downtrend, and they cover. America's data center boom is largely being powered by gas and coal plants. That's why we have Comstock, which continues to rock and roll. I think it was up to $22 today. We were pounding the table on this podcast at $8 and $9. May is historically strong in a post-election year. Kind of throw this out the window with this administration, although it did sort of hold up, with the exception of, no, it didn't hold up. March and April were down a lot, and it should have been strong, but it was what it was. It's more than made up for it, and will continue to do so. Data centers drive record surge in tech investment. 2-year trailing price returns. Q2 Atlanta GDP now estimate is positive. So far, and that's probably why they're getting these deals done quickly and juicing the market, because they don't want a negative wealth effect. When people's portfolios go down, they stop spending. If they keep the market up and people keep spending, they won't get that second quarter of negative GDP growth, which is a technical recession. So this is very critical that stays positive. Share of investment flows from mainland China into Hong Kong is growing, very much in line with our original thesis. U.S. fundamental long short ratio, so they are record short in the hole like we've never seen, and just as they were record long at the peak in 2021, which is why you're seeing all the forced buyers that we covered before the fact, both with CNA and with David Lynn. S&P 500 versus Europe returns when U.S. dollar is strong versus weak. Strong dollar, S&P outperforms. Weak dollar, everything else outperforms. That is the core of our thesis. That is what we've been talking about for 6 months. And that is why those of you who listened outperformed everything in the first quarter with ex-US. 12-month housing price changes, prior year versus most recent year. You can see the difference by region. Affordability is going up is the theme of that. China, U.S. exempt about a quarter of imports from tariffs. Estimated value of exemptions. U.S. imports from China. China imports from U.S. So there's already some movement that already happened. We're obviously paying close attention to the talks in Geneva this weekend. Those will be critically important. You can see what's happened here just in the last few weeks. The percentage of S&P 500 members above the 20-day moving average has skyrocketed. Weekly that's all the forced buyers that we warned were coming, warned in a good way. Q1 earnings season has seen a huge surge in buyback announcements to record highs. That's going to also help earnings. Retail investors bought the dip in line with other major volatility episodes yet again. And what I've said is proven correct, is that since COVID, retail investors have been right. They've been buying on weakness, and institutional investors and hedge funds have been wrong. They've been selling at the exact wrong time. Cash-like ETFs head for record inflow in April. There you go. That's all going to be forced back into the market just when we're at the next short-term top. More good news for the bulls. This is from Carson. Returns after recovering 50% of the bear market, 1950 to current. 6 months later, up 10%. 12 months later, up 18%. Home prices versus affordability. You can see the price index is at the biggest extreme since 2006, 2007. I think this is going to get solved pretty quickly, and we're going to cover it in the article of the week and talk about why and how. Impact, that's going to be a theme for us moving forward, is the home building recovery. Impact of policy uncertainty on S&P 500 cash use, controlling for all other variables. That was in the first quarter, and then they had the April reversals in the S&P 500 was one of the biggest in history, going back to 2001, which is a model that we've used, and COVID. Those were the only two bigger turnarounds in the month of April in the last 30 years, and maybe throughout history. U.S. importers expect a double-digit decline in import volume from May. Can't tell you how many clients have called me in the last week and said, "Oh my God, I cannot believe how timely and prescient that special webinar you did for us was." It was literally a 35-minute call for all my money management clients the day before Trump put out that now's the time to buy stocks. Actually, it was 2 days, because if I remember, Trump put that out on Thursday, and I put out the podcast, the webinar for clients, maybe Monday or Tuesday night. Anyway, I just said to them, if you're ever thinking about adding more money, now is the time. The last time I told you guys to do this was October 2022 and a little bit in March of 2023, but really pounded the table. I never come on and say this, and so many of them took me up on it, and they're calling me up. They're like, "I can't believe it. I was shaken to do it, and like here we are." It's just been, I'm so excited for them. And those who hung through, I didn't get any phone calls of people saying, "Oh, what's going on?" I got a couple, but it was more like, should I add more money, blah, 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 et cetera. And every single one I just best amazing clients, stuck it through. And now you're just beginning to see the rewards. Like, yeah, Cooper Standard's doing great. Bob is coming back. Great. And Comstock, all these others. And the P&Ls are just unbelievable on a relative basis to everyone else. But if you look by company based on the fundamentals that they've reported, it's like we've got 10 more Cooper Standards in our portfolio that haven't even begun yet. It's just beyond exciting right now, is what I could say. That doesn't mean we won't get a pullback now that everyone's excited because we've been up, 10 days in a row. But it's pretty cool. Sell side equity sentiment fell, so that's good. No signs of selling for U.S. stocks. Good. Increasing crowded stocks would have underperformed by 5% per annum since 2009. This is basically saying if you crowd into the most crowded trades like Mag 7, eventually catches up with you and erases all the outperformance that you had in previous periods. That was a big table pounder coming into this year. Get the hell out of Mag 7, and that's proven to be prescient. Long only funds exposure to cyclical and defensive sectors is near an all-time low. What does that mean? Consumer discretionary, you think about VF Corp, you think about the Nikes of the world, you think about materials, the Albemarle's, industrials, the Generacs. Now these things are going to get bid by the people who missed it, are going to have to play catch up, and we've seen this game before, and it's just going to be violent to the upside for all the left behind stocks, which is exciting. Cash near low. 67%. Okay, we'll cover earnings at the end. Earnings have been amazing this quarter. And guidance, a lot better than expected. Project delay mentions start to pick up, but still well below COVID levels. So that is understandable, and that's the risk, the lagged effect of that. But I think now with this real concrete deal announced, people are going to say, we know what direction they're headed. We should probably invest while there's still some level of uncertainty so we can get a little bit of a discount in doing so. Consensus sees growth spread between the Magnificent Seven and other 493 narrowing. So again, you continue to see a resurgence in the XMAG 7 and a significant deceleration in earnings growth in the Mag 7. That was the core tenet to our thesis going into the year. S&P 500's longest winning streak since 2004. So one more thing pointing to the early 2000s, which has been key part of our theme for the last 6 months. Prime book, global energy, positive value equals net buying. So the world is pretty negative on energy stocks, and I just am not at the point where it's a super fat, other than what, when we were buying Comstock in the 8s and 9s and pounding the table on the podcast, there's nothing there that is just pound the table, I can't get enough of, easy double over 3 years. And there are a few, but they're just not quality enough for me to want to risk capital there. So I continue to pay attention to it. I think there's going to be a violent move. We will participate through Comstock Resources, but maybe we'll get one more in before it goes, and maybe we won't. But it is what it is. I got to find something that's a slam dunk where my downside is protected, and that's the problem with a lot of energy. Your downside's not protected under $50. And the upside's at least a double to a triple over 2, 3, 4 years, and I'm just not finding that yet. So, sector fund flows, you can see it there. Buffett, how he crushed it for decades, performance against iconic. So he basically had 19.9, 5.5 million % returns. But what that worked out to on an annual basis is about 19.9% returns versus the S&P, which was 10.5%. So almost double the S&P. And if you really have studied him and know, it wasn't so much because 3% of his investment decisions actually moved the needle, which is amazing when you think about it. The biggest thing he did was avoid the mistakes. Okay, so he didn't play in the tech bubble in 2000 when everyone said, has Buffett lost his touch? He has no tech exposure, et cetera. So he avoided that. And by avoiding those huge 80 and 90% drawdowns, Nifty 50 in the 70s, tech wreck, huge exposure to housing during the great financial crisis, and by avoiding those mistakes is how he really got the dramatic outperformance over time. It wasn't because every decision he made was right, because again, a few percentage made up the bulk of his good decisions. So short interest very high on the Russell 2000. Do not give up on short caps. They're just starting to go. That's going to be a huge second half beneficiary that we will benefit from. Healthcare versus staples price. So you got healthcare versus staples revisions, and then you got price. So healthcare is a space. Obviously, we have Baxter. We've got biotech basket XBI. I think those are also going to be great back half plays. Many categories of retailer, 2 months or less of inventory, so you'll have some more restocking there. Trump's first term, public comments. Public comments on Fed policy led to modestly lower rates pricing. Okay, interesting. Business confidence and capital spending expectations have collapsed in the last 2 months. That's going to start to resurge in the next 4 to 8 weeks. Main Street Meter, that's U.S. Consumer Confidence Index divided by U.S. labor employment rate. So you've seen a little bit of drop off in that recently. So it's something to keep an eye on. Looks a little bit like 92, looks a little bit like 2003. So that's that. We've covered the difference between the hard data and the soft data. What people are saying is they're despondent. What people are doing is they're euphoric. They're spending and they're going out and they're partying like there's no tomorrow. What they're talking about here is the average annualized forward 1 year and 3 year total returns, 1955 to 2025, when sentiment gets this low into the bottom quintile, and your forward 3 year average annual S&P return, total return is 14.3% per year when sentiment gets this low, and forward 1 year return is 17%. Okay, so you get a huge snapback when sentiment gets this low. A lot of bets on tariffs falling in China. That's pretty obvious. Trump talked about it today. Chart of the day, where are the inventories? Retailers currently hold about 35 days of inventory, which is near the record low seen during COVID. So they're going to have to rebuild those inventories. That's going to be a potential issue if we see the backups, but I don't think it'll be as hard to get back online quickly as it was during those periods. It's just we need to see a little bit of progress this weekend in Geneva. That will be helpful. China cuts key reserve ratio to aid economy hit by tariffs. Cumulative U.S. net trader flow. You're seeing a lot of selling in staples, a lot of buying in financials. That's in the last 20 days. You could see here when I always joke about Comac, they delivered 13 planes last year. Boeing, on the other hand, is going to do 448 this year. Airbus is going to do over 600. Over the next, between now and 2034, Boeing's going to deliver 6,200, Airbus 8,400, Comac, if they're lucky, 780. So the Chinese need Boeing like a diabetic needs insulin. S&P 500 revenue from China is roughly 4 times the U.S. trade deficit with China. This is a chart that the Chinese should probably bring to the table. The S&P 500 companies get almost $1.2 trillion of revenue from China. The U.S. trade deficit with China is only $295 billion. So something to keep in mind. Longest private client buying streak in our data history. This is from Bank of America. So again, the retail investors came in and started buying stocks. S&P EPS versus the Fed. EPS breath suggests that the Fed should be in cutting mode, not pausing. They are too restrictive. Let's see how things look between now and June. I think if the inflation number stays subdued, they are going to be cutting for sure in June. Also have to watch the labor numbers. If they get 1 week report where the unemployment rate goes from 4.2 to 4.4, I think you'll definitely see a cut in June, which will be a Goldilocks type of scenario. First-time home buyers in age group 26 to 34 is 71%. Median age of U.S. home buyers has gone up to 38. U.S. dollar underperformed FX majors in the first 100 days. All the other major currencies were up. Euro up 10%, US dollar down 9%, British pound up 10%. That was a key theme we were pounding the table on in Q4. That has begun to play out. 4-year average in share buybacks versus the S&P 500 got very, very negative early in the year, now has spiked positive. Retail buying of U.S. domiciled EU ADRs and Europe-focused ETFs has gone straight up. 30-year fixed mortgage rate versus purchase mortgage applications index. You can see how this resolves. as rates come down, purchase mortgage applications go through the roof. We saw the exact same thing in 2020 through 2022, and then going back a little bit to 2013. Stock buyback set to blow past 1 trillion for the first time this year. That's been in the last couple of weeks. That is a sign of confidence. That is a sea change. U.S. trade deficit is in goods and services as of March 31st has gone to a record. That's what they're doing here. You can see the dollar versus the 10-year yield. 10-year yield should start to follow the dollar pretty aggressively down. Again, when the 10-year yield was knocking on the door for 5, we said it's going below 4 before it goes above 5. Everyone was certain it was going above 5. I think we're going to see 375 at some point this year, and that's going to give us a high 5s in the 30-year fixed mortgage, and that is going to be a housing Lollapalooza, as Charlie Munger would reference. Okay, so we just went from below the 200. This is from Urian Timmer, back above the 200-day moving average. Okay, so that's has some significance. Auction demand remains healthy for treasuries. Breadth narrowed a little bit in April. Only 40% of stocks outperformed the S&P 500, down from 60% in March. So something to keep an eye on. And moving along, Trump hails UK trade framework as the first of many tariff deals. And Lutnick was on this afternoon saying the same, dozens rolling out in the next couple of months. Trump says substantive China talks could yield a tariff cut. That's a about face from what was said yesterday. China cuts key rate reserve ratio to aid economy hit by tariffs. Besant working on clear rules for U.S. investment in China. Let's see, U.S. to overhaul curbs on AI chip exports after industry backlash. So that's positive. Alibaba's Qwen 3 topples DeepSeek R1 as world's highest ranked open source AI model. We covered that with the table. U.S.-China tariff pause reasonable to expect, Council says. Alipay and WeChat Pay see booming inbound spending in China during Labor Day holiday. Preliminary data from the country's 2 dominant mobile payment apps show 2 to 3 times the spending from a year ago. That is huge, ladies and gentlemen. And speaking of which, Alibaba, if you remember, the tech crackdown started with the pulling of the Ant Financial IPO. Well, it looks like it's now going to go public in the next year. We own 1/3 of that through our ownership in 9988, aka Alibaba. Chinese stocks look like an opportunity amid Trump's tariff chaos. You'll notice all the Barron's articles are being written by new authors. The lady who wrote 135 consecutive negative headlines about China is no longer, I don't know if she's even with the company, but she's certainly not covering China anymore. And I joked, it was like having a Palestinian write articles about Israeli tech companies. It just didn't work. So now we're getting more balanced. Opinion follows trend. Warren Buffett plans to step down as Berkshire CEO at year end. We covered all of that. CEOs celebrate Warren Buffett as he calls close on a 5.5 million % run, aka 19.9% a year compounded. Just absolute legend. Disney new theme park hotspot, the Middle East. So this was a big announcement this week in the UAE. U.S. exports of natural gas liquids touch record high in April. That was part of our original Comstock thesis, and more of that's to come because that's going to be part of the EU trade negotiations. You take all of our natural gas, stop getting it from Russia, we will lower your tariffs to a more reasonable rate than our opening offer. Hartnett over at Bank of America, market now expecting Trump pivot to lower tariffs, lower rates, and lower taxes, and lower regulation, by the way. And this is what we said in the middle of the chaos. Just watch. It's going to be one headline, and then the focus is going to start to shift to growth, deregulation, tax cuts, etc. And we're going to be off to the races, and you're going to have missed it. And that's exactly what's starting to happen. U.S. auto sales up 9.9% in April on rush demand, inventory decline, and price spikes concerns going forward. The big thing going forward is they're going to have to replenish all that inventory. Trump's auto tariff relief shields USMCA auto parts from 25% tax. Jeff Edwards covered that in the Cooper Standard earnings call, which we'll touch on in the article of the week. Home builders are piling on discounts as they struggle to entice buyers. Again, we want to be in the arms dealers, not the ones fighting the war. Both the home OEMs like Pulte, DR Horton, etc., and the car OEMs, Ford, GM, etc., they are all going to be producing massive volumes in a race to the bottom in margins. We want to benefit from who are the players that are going to benefit from high volumes and not be affected by the OEM margins nearly as much. And that is the building supply products like QXO, Brad Jacobs, which we own, and obviously the ancillary plays like Stanley Black & Decker, Generac on the housing front, and Cooper Standard on the auto front. Small cap stocks have suffered. It's time to be cautiously optimistic. Barron's greatest business publication in history, talking about advanced auto parts. So much for not a safe asset. Yields tumble after stellar 10-year Treasury auctions. Stops through on soaring direct demand. Okay, so the game is back on. Yields are going lower. Everything is falling into place. Venmo, owned by PayPal, obviously. And by the way, even PayPal starting to move now back over 70, gaining ground in payments as Cash App struggles. I remember every single week when we initiated PayPal and then bought more in the high 50s, everyone was like, what about Block? Cash App is so popular. I was like, it's a bag of you know what. Same thing I said about Pinduoduo, and that's now proving out in both cases. GXO secures 2.5 billion NHS logistics contract. So even GXO is starting to rebound. And now on to our article of the week: new homes, new rides, stock market and sentiment results. Covered all the media. Cooper Standard, we're going to touch on some of the key points here. Obviously, it's had a huge move, some 70% in the last 4 sessions, but it's not a mistake, okay? The stock was down, 98%, give or take, when we bought it, and or 95%, and no, probably 97%, actually, 146 down to 5. And by the way, as brilliant as we were buying in the 5s when we started the position, it went to 385 before it's gone back up to 26 and started its recovery. But opinion follows trend, but price follows fundamentals. Sooner or later, the market is a weighing machine. In the short term, it's a voting machine based on emotions. In the long term, it's a weighing machine based on fundamentals. And the stock price is not going up because, a quote unquote short squeeze. That's part of it. They're the first buyers, obviously. But it's going up because free cash flow is going up, revenues are going up, their execution is going up, volumes are going up, and that's what you need to see. Adjusted EBITDA went from 29 million last year to 58 million this year on effectively FX adjusted same revenues. Double the EBITDA. So they continue to execute. Negative 30 million loss first quarter last year. Positive net income, 3.5 million this year. So you can see the huge impact of foreign exchange, the variance here. But the underlying business units is improving, and the margins on each unit has dramatically improved, both due to pricing, both to execution, both to cost cuts, etc. So you can see there. I think the most important thing here was, number one, they received an award from Toyota, and Toyota is a very small part of their business. It looks like that's going to become a much larger part of the business. And the reason that's important is because hybrids are the future, and Toyota is very, very good at hybrids. So the fact that Toyota is awarding them with an amazing supplier excellence award shows that they're going to get a lot more new business awards from Toyota going forward. And Toyota is a leader in hybrids. And part of the reason they're a leader in hybrids is because when everyone else was following the herd into EVs, their CEO said it just doesn't make sense. And he held ground. They kicked him out. And 2 years after he was out, everyone said, oh, you were right. And they're just dominating. So that's good to see that Cooper Standard's going to get a piece of that. Record liquidity that we've seen in the last 2 years, $300 million between cash on hand of 140 and their lending facility of 160. All the industry is moving towards hybrid basically in the US, and they get 80% more per unit on a hybrid than they do on an ICE, and they get 20% more on an EV than they do on an ICE. So as the things trend, which was not in our original model and is not in the 2017 numbers. So when we talk about $7 to $10 of earnings, that's really not accounting for what can happen if this mix continues to be positive, which is why on the interview that I did with Jeff Edwards, we emphasized variable contribution margin, and he believes he can get to 2 times leverage from 4.5 times, even without a refinance. Number one, because of the execution and the cost cuts, but number two, because the amount per car that they're making and going to continue to make as the mix shifts to more hybrids and EVs, but predominantly hybrids. Further margin expansion. That's the story that he continues to pound the table on, and he has for a year and a half, as he promised to get back to double-digit EBITDA margins, double-digit return on invested capital, and he is confident to deliver on that by the end of this year, which is pretty exciting. It's always been a manana story. Now it's a now story, and the stock is starting to reflect that. CPS Supplier of the Year, covered the Toyota, increased hybrid consumption, we covered that. EBITDA margins, we covered that. Management expects to mitigate or recover the vast majority of direct tariff impacts and does not view tariffs as a significant cost headwind going forward. The vast majority of parts fall under the free trade umbrella, making tariffs much less of a threat for Cooper Standard compared to other Tier 1 suppliers. For the small amount that was paid, about $2 million, management expects to be reimbursed by the OEMs. So far, management has seen no significant changes to Q2 compared to the original volume expectations, with mix coming in more favorable due to higher truck and SUV production. Production schedules remain intact, and with many OEMs offering favorable incentive plans like employee pricing through June, domestic inventories, which were already 30% below historic averages, continue to be depleted. Inventories will have to be replenished, suggesting strong second half production outlook. Free cash flow was a net outflow of approximately $32 million, in line with last year. However, Q1 has historically always been a working capital outflow from a seasonality perspective. Cash and cash equivalents total $140 million, bringing total liquidity to $300 million. The EcoFlow switch pump recently won the Automotive News PACE Pilot Award, a key industry benchmark for emerging technologies. Management expects that as production of this technology ramps up and becomes fully commercialized, it will drive further profitable growth and expand the 80% cost per vehicle opportunity in hybrids even higher. This is key because it's a win-win. What they've done with this EcoFlow switch pump is they've reduced the amount of parts that the OEM needs. So even though Cooper Standard is getting more money, the OEM is spending a less amount of money on that application. So effectively, Cooper Standard's innovation has eliminated the need for them to buy ancillary parts from other suppliers. So they wind up spending less overall money, the OEMs, but they give all of that less money to Cooper Standard, which is more than Cooper Standard was getting to them before. So it's a win-win for Cooper Standard, a loss for the other less innovative suppliers, and we like that. They're hitting on all cylinders. Cooper Standard continues to target a net leverage ratio of less than 2 times by the end of 2027, which would be less than half of the current 4.6. This target assumes normalized volume levels and, most importantly, does not factor in a global refi, which now is looking more and more likely sooner rather than later as the 10-year yield comes down. I think that the minute you see the 10-year yield at 380 or 375, they're going to refinance the whole thing and probably take out 20-30 million of interest costs, which is basically buck and a half of earnings per share just on that. Cooper Standard was awarded 55 million in new net business during the quarter. CapEx as a percentage of sales during the quarter was 2.6, well below average of 4 to 5% as management focuses on maximizing return on invested capital and maintaining capital discipline. Then you saw from Michael Ward at Citi, auto manufacturers, parts and equipment, the demand picture is bright when the tariff fog clears. Well, the fog is clearing, so the demand picture is bright. What they're talking about is all the things that we've been talking about since May of 2022 when we initiated the position. In the short term, they're talking about the inventory levels, which we covered. Then they're talking about demographics, which was core to our thesis. U.S. vehicle fleet approaching 13 years. Replacement accelerates with age. By our estimates, there are 140 million, 45 to 50% of the total population of vehicles registered in the U.S. are more than 12 years old. The scrap rate for a vehicle over 12 years of age is 9 to 10% annually, compared with a rate of under 1% for vehicles under 12 years. Scrappage of an older vehicle eventually leads to new vehicle sale. The new market is the only source of a used vehicle. The replacement cost of the oldest fleet on record by our estimates will result in a replacement demand of 12 to 14 million units annually over the next 3 to 5 years. Since 2000, the replacement rate of vehicle population has averaged 4.8% annually. The oldest fleet on record should keep the scrap rate elevated. At the low end, a 4% rate results in 12 million units of replacement demand, and the average rate of 4.8% leads to replacement levels of 14 million units annually. Millennials fuel growth in licensed drivers. Born between 81 and 96 is currently the largest U.S. population demographic, and the group has entered the prime age for home and vehicle ownership. Which are two of our key themes, ladies and gentlemen. The percentage of people with a license to drive grows from about 85% of people in their 20s to 90% of the people in their 40s. 91% of the 35 to 44 age group have a driver license to drive in line with historical levels. Percentage is likely to move higher over the next 5 to 10 years as the rest of the millennial generation moves into their 40s. Growth in drivers. As expected, growth in the number of drivers in the 2023 to 2027 period is expected to be the highest level in over 40 years. You can see here from trough back to peak, which will be meaningfully higher than the 2017 peak, which is mind-boggling. Trend demand, 16 to 18 million units annually. Ladies and gentlemen, everything magical about what our models have been built on is around 16.5 to 17. And if they go as high as 18, then we have underestimated what this stock can do over time. Inventory levels low, benefit from positive demographic trends. Production tailwind, 2.6 million. Stronger than expected sales in the first half will leave inventory levels depleted, leading to positive production comps for the second half into 2026. And the first one here is Cooper Standard. Should be in good position for accelerating industry volume. More disciplined capital spending, 20% reduction in debt, transferring that value to the equity. Hello. Margin improvement. Completed headcount reductions, 150 to 200 basis points to margin, etc. Okay, then you have the earnings call, which we covered quite a bit of that. Such incentives, liquidity, and then everything about the tariff. So you can read through this. I mean, this was really an amazing call. But we'll be here all night. Then Stanley Black & Decker, which is a play on the themes. This got absolute monkey hammered in April following the tariff announcements. This, ladies and gentlemen, it comes down to share. And if you zoom out on this one, it's exactly like what you saw in the early 2000s. You had this huge rally, correction, looked like it was recovering, a complete wipeout, which is where we are right now, complete wipeout, and then a recovery almost all the way back up to new highs, which would imply, in this case, it would imply a $180 stock, okay? And I think that's conservative long-term, but it's where we are now, so we've been buying more. That's all I can tell you. This is, manna from heaven. You can see they've taken almost $2 billion of costs out, and we love this story prospectively, and we've got a very, very low basis on this now. Look at what's happened here. Price, cash flow has fully recovered. Price is actually lower than when cash flow was at its most negative. We love stories that playing these divergences are where fortunes are made. And when we get a fastball down the middle like this, it's just, we cannot resist. The only issue with problems like this is just not exceeding our position weight sizing and having unlimited capital. And that's what we want to take advantage of for our clients, because this is our next Cooper standard. I mean, let me not say that. Cooper standard is a unique situation. It's, Cooper is already up 5x from our initial basis. It's going to probably do at some point, I think, I think it could do another 4x from here over time. That's, if everything goes according to plan. And you'll manage around it as it goes up, obviously, and you'll have a piece of it that if it goes to 200, you'll still be able to participate, but you're not going to, risk every marble, going from 100 to 200. You got to, pigs get slaughtered, so you manage it and you take some profits on the way up. But I really think that can be special. So Stanley, different story, more like a BABA 3-bagger, 4-bagger type of thing. From here, is amazing. Okay. And if you want more than a double, triple, you buy something like QXO, where you're betting on the guy in the case of Brad Jacobs, and that you tuck away for 5 to 7 years and you wind up with a 7-8 bagger as well, because he's doing what he does amazingly well. He's using public multiple arbitrage to buy small businesses and fragmented businesses now that he has his platform. And then he uses the public currency at the high multiple to buy the private fragmented business with a subpar multiple, rinse, repeat, add technology, take costs out, increase EBITDA, free cash flow, rinse and repeat. And then he'll get 10, 15% of the total industry with double-digit EBITDA margin and have an $80, $100 billion company. Or you can think about it or chase the latest shiny object, hoping you can get the extra dollar and find a sucker to buy after you, hoping the whole thing trading at 100 times sales and making no money doesn't collapse and you're left holding the bag. So we avoid those situations in the latter, and we gravitate towards the situations in the former. The key thing here is they've taken out, they're close to finishing the $2 billion of costs, which I think we had done the math on previously. All I can tell you is the smallest amount of improvement in construction is going to be a hockey stick to earnings. And when you look at the demand that we just covered for cars, which also applies for housing formation and new housing, what you're going to see with Stanley is going to be phenomenal. DeWalt is back to revenue growth. Some key points here. Margins came in at 30.4. Their target is 35. The last time they did 35% margin and earned 160, I forget what their operating income was, but it translated to $160 to $185. In other words, when they hit 35% margins, the earnings power, the last time they had that level of earnings power the stock was trading between $160 and $180 a share. Okay, that's assuming very limited growth. That's just assuming the margin expansion, steady state, etc. The beauty of housing, like auto suppliers, is when they turn, the amount of operating leverage is insane, and you get these hockey sticks. Like, it's like, oh, should I buy it at, oh, I bought it at $75. It's $60. Like, it's a rounding. It makes no difference. It's a complete rounding error, because when these things go, this is going to be $150, $180, $200 stock. And whether you bought it at $71 or $63 or $81 makes literally zero difference. What would be problematic is if you bought it at 80 and you sold it at 60 and you wind up buying it at 150 because you're an idiot, okay, and you missed it. Okay. The key is, if you bought it at 80 and it went to 60 and you didn't buy more and bring your basis down to 70, then you missed an opportunity. There's nothing I could do for you because you don't understand what you own. But if you actually do the work, and I'm not even asking you to do the hours upon hours of work that we're doing here, and Jeff did a great job of compiling all this for our weekly article. If all you do is you take the 30 minutes to actually read it and understand it, even if you don't listen to the hours of conference call, of competitors' conference calls, of channel checks, of industry checks, even if you don't do any of that, even if you just read, you would know what you own. And I think some people make the mistake of an unwillingness to burden themselves with the facts, because once you burden yourself with the facts, you're like, holy shit, things like this come around. Like, I mean, in the case of Stanley Black & Decker, you get an opportunity like this once every 10 to 15 years, okay? Last time you had the opportunity was the great financial crisis, so 16 years ago. Before that, it was 9 years before that you had an opportunity to buy it at these levels of complete dislocation. But the fact of the matter, DeWalt, Stanley, Craftsman, these have been around for decades. Generations upon generations have used them. Why? Because they're the best. They are the best brand. They've got brand equity, and when the underlying conditions, which are perfectly set, all we need is the 10. We're going to cover a lot of this at the Money Show, by the way, with the amount of federal land that they're going to open up, with what's going to happen with rates, with all the conditions that are going to be in place, and the explicit demand. These are a better way to play it than the home builders, which are going to be fighting margin wars against each other and having to produce more and more and more to keep their earnings going. We're the arms dealers. We're going to make the most money in the shortest amount of time with the Stanleys and with the Generacs and with the QXOs. So you should go through this. We even highlighted the important parts in green, so you can see what happens with tariffs and how a lot of the stuff's covered under USMCA. Very similar story to Cooper Standard. The only difference is Cooper started to move. It's up 5x. Stanley's going to start to move. It'll be a double probably a year from now. And then people will look back and say, I missed it. And they'll buy it up, 1.5 times. It'll correct 40%. They'll sell it the whole. And then at 180, 200, they'll be chasing up, and it'll be over. And that's just the way it goes. Generac, exact same story. Look what's happened to free cash flow. Look what's happened to price. Our price is back to levels it was when cash flow was completely negative. This thing is just getting started. This is a normal cyclical recovery for Generac, and the game is just starting. So, we're way in here. So I got key points we've covered in the past. C&I business starting to recover. That's good to see. So at the very least, go through the 10 key points. If you're not even willing to read that, go through that, and you can see why we're so excited about these opportunities. And we spent the last 4 weeks just loading the boat every which way we could. Disney shot the lights out. We're going to cover that in more detail next week. Some sentiment is coming back into the market, but not extreme yet. So there's more to do. Earnings, NASDAQ, top 30 weights in the last 60 days. Estimates went up by 1.1%. And for next year went up 2 basis points. Dow went down a little bit by 2.48% for this year, 2.65 for next year. Economic data. Non-manufacturing PMI was in expansion, came in better than expected. see if there's anything else here we need to know about. Continuing claims came in lower than expected. Initial jobless claims came in lower than expected. And there you go. And then earnings were expected to grow at 6% this quarter. They actually grew at 12.8%, with over 80% of the companies now recording. And look what happened to estimates, ladies and gentlemen. They stopped going down. They were down 3.6% at 265. They're now at 266 for this year, and still 302 for next year. Okay, so the podcast is done. For those of you who love the Ask Me Anything questions from the audience, we're going to cover at least 5 of them now. We'll cover as many as we can, but this one's running long. So let's see here. Okay, Paul asks about Advanced Auto Parts. He says, Third Point took an active position, and then they exited their position. Yeah, so I would say 2 things about that. Number one, we never got in because Third Point was involved, and we would never get out because Third Point is involved. We get in and out because we do our own work. We love what Shane O'Kelly has done. He's done everything that he said he was going to do: deleverage by selling off Canada, shut down the non-profitable stores, cut all the losses, cut the costs, start the hub and spoke model in the areas that they are the leaders. And now that they've done all the cleanup work, guess what they're doing? They're going to open up 100 new stores over the next couple of years. That is not what you hear from a company that's going out of business, that they're opening up 100 new stores. So we're excited about that one. Thanks for sending that in, Robert, but it's irrelevant. I don't invest on the basis of what other people do. If they happen to invest after I invest, great. Happy to have them on board. It brings more attention to the name. But I could care less. I underwrite each individual business as if I was buying the local bodega, and I wanted to see their financial statements before I made an offer. York Bourgeois. Yeah, York, just study the conference call. All the answers to your questions are there. You don't have to ask me. All you have to do is just read what management tells you and verify, and you're golden. But congratulations on buying more shares at 13. You're already up on a double. Chris Williamson, can you look at Becton Dickinson? Okay. Yeah, I think there's going to be great opportunities with the medical device companies. But we're playing it through Baxter. I think BDX is okay, though. BDX. What? Oh, I'm not signed in. I'm like, where is my... All right, so BDX, let's take a look at this. Yeah, it's interesting. This one's complicated, and I've continued to look at this, and I've continued to do nothing. And honestly, some of it is just instinct and gut after a while. Especially, I never make an investment on instinct and gut, but I will avoid an investment on instinct and gut because there's no penalty for avoiding an investment. There's predominantly a penalty for, errors of omission versus commission. If you commit capital and you're wrong, you got a problem. If you pass on something and it works without you, it's fine, because it's like, which one of your other babies were you going to sell, and et cetera, that you've done all the work on. I mean, this has always kind of been a low quality business in terms of inability to compound capital that you give to it above what you could get for free. So that's why I'm not a huge fan of it. Balance sheet, probably okay. Let's see. $20 billion. Yeah, it seems a little bit leveraged. It's $18 billion, $2 billion of cash. That's probably a little bit of an issue. I mean, I don't think they're not going to be bankrupt or anything like that, but it's a lot of leverage for that type of business. Generating $3 billion of free cash flow. This is a tough one. I mean, this stock has gone nowhere in almost a decade, so you definitely need a catalyst and new management. I think it's early. I think you're generally right. I think it's early. I think it's going to take a while because it broke a lot of institutional money that thought this was safe. And it's going to take a while to build a new level of sponsorship, probably around the 150s and 140s. And it may take 2-3 years for them to kind of turn this. So for me, it's a pass. I mean, you could get a quick recovery, but it's just not obvious to me. So I'm going to pass. Ever looked at B&G Foods? Yeah, we've had it on a couple of times and we passed, and I think it went a lot lower. Let me just see. B&G. I can't even find the ticker. I'll try it. BGS, okay. If you're buying it for the dividend, don't waste your time. So sales have done nothing in 5 years. Are they buying in shares? No, they're issuing shares. So their sales are not growing and they're issuing equity at record low valuations. That is a no-no for me. That is like wall of shame, executive action. Free cash flow is 100 million. What's their balance sheet look like? 50 million. And what's the debt? 2 billion. It's priced for bankruptcy. I don't know that it will go bankrupt. It might recover. Then you're going to get huge equity leverage. But I want to hear the turnaround plan. For me, it's down for a reason. It could definitely be a trade. I don't like the story. David Gavin asked me about favorite investments of all time. I mean, a lot of them have been, it's not just the equity being up multi-bags, it's whether it's, Range Resources, Rolls-Royce, a bunch of the others. I would say in many cases, it was the option expression that got 10 bagger plus on top of the multi-bagger equity where we made huge amounts of money. So it's structuring those and taking advantage of how we do that for our clients. FLL from a good friend, first initial J. You know who you are. Let's see here. This is a casino play. Stock's down 2/3. FLL. These are tough. Usually what I do with casinos, it's like Wynn or Las Vegas Sands when they're down. So this is negative free cash flow. Their revenues are growing. They're building a new casino. It hasn't turned positive free cash flow yet. It seems like it's trending in the right direction. Let's see what the balance sheet looks like. I think they just built a new casino in Colorado, if I remember. So they got 40 million of cash. And they got $500 million of debt. That's cutting it close, boys. It's never really compounded capital for owners. Let's see what their free cash flow looks like on that $2 billion of debt. Negative free cash flow last 3 years. So, you know, I think they did a Hail Mary pass here on the new casino. And if it works, it could work. What are they doing to shares? Increasing the amount of shares. This is not the kind of thing I like to touch. And the other thing is, this has a history of being a disaster. Like, they've never created wealth for their owners in 3 decades. So it sounds to me like they're operating subpar assets. Maybe this new one will be their saving grace and it's the Hail Mary that works. But if the asset structure and the management company haven't been able to generate any wealth for their owners in 3 decades, it's probably safe to say that they will continue to destroy wealth in the form of opportunity cost for the next few decades. So for this one, I'm a pass. I do hope it works, but I'm not going to be involved. Johannes. Hi, Tom. Big fan of the podcast. Been listening. I was wondering what you think about Whirlpool, play on the housing market comeback. I like it. We've covered it before. We haven't done anything. And I think now's the time. Let me just double check. I think there were some yellow flags when we last looked at it, but I think you're on the right track. So cash flow is just starting to inflect. Revenues have collapsed. I think that was a worry for us. We wanted to understand the turnaround plan, and we haven't gotten any comfort. Let's just see if they've got enough runway to figure out their turnaround plan. I mean, this is a big drop in earnings, in revenues, 25% drop in revenues. What are they doing to the share count? They're taking it down a little bit. That's good. Cash flow. They paid back some debt, repurchased some stock. Free cash flow positive, although moving in the wrong direction. 1.2 billion of cash, 4 billion of debt. I kind of like this one. You know, it definitely warrants doing the work on it. You put a gun to my head, I would buy it. So, but there's not a gun to my head, so I don't have to buy it. Philippe Andrew Pincos, Interfor Corporation, lumber producer. I generally don't do commodity plays in equities because I got to win on 2 bets: the price of the commodity and management's operational discipline and excellence, with the exception of energy companies from time to time. But let's take a look at it for fun here. IFP. All right, so the price has come down along with the cash flow and the revenues and the margins. Okay, so your bet is that lumber prices are recovering. I mean, I guess it's a backdoor play on housing as well. Let's see if you got enough runway to see it through. Got 30 million of cash, down from 400. $600 million of debt. You got a problem, cowboy. I think you're right that it's going to rebound. The question is whether you're going to be around to benefit from it. I think you got to do a lot of work on this. I think it's interesting, but I think you're on a knife's edge there. But so you got to understand, when does the debt mature? What is the interest rate? Is it expected to go up or down? And then do a sensitivity analysis based on every commodity price for lumber. It's a lot of work. For me, that goes in the too hard pile. I think you're going to be right, though. Eric C. was wondering if you have any thoughts on UPS. We covered that one a few weeks ago. We like it, but we like it at lower levels was the short answer. Let's see. Oh, it got to lower levels. So I think it's interesting, but it's a broken stock, so it's going to take a couple years to build a base. I think you're going to have time to get into it. It'll probably rebound quickly now and then go back down and languish there for a while. I think you're right. I mean, if I can get it at 70 or 80, then I'm willing to wait 3 years with it being dead money, because when it recovers, it's going to be, double or triple. But I just think it's early. It's broken. They destroyed a ton of institutional holders, and it's going to take an awful long time to rebuild trust and rebuild a shareholder base. So for that reason, I'm going to pass, even though I think you're right. Let me just quickly look at some of the financials here. $20 billion of debt on 6. Let's see what they've done to the share account. Yeah, I like it. I like the idea. I like the story. I like it all. I think it's going to take longer than you think to recover, but I think it's definitely going to recover. So it's a good idea, and I'm not going to participate, but I'm going to keep a strong eye. Like, it could easily go from 95 back to 150, and I'll just be happy. I'm just not involved. It's okay. But if it did move down to 70, which I highly doubt, I'd be willing to buy it knowing it's going to be dead money for 2 years, because my IRR 3 to 5 years out would be high enough. It's not high enough from here for me to accept the possibility of dead money for 2 to 3 years while they rebuild a shareholder base. Would appreciate your opinion on buying BABA on the Frankfurt Stock Exchange. Then you have FX risk, etc. Look, then you're making like 3 bets instead of 1. So you're never going to have certainty on anything. We own the shares on Hong Kong. We own the derivatives on the US. We understand the risks. We fully could see the derivatives go to 0. I think the probability of that is sub 10%, I think, to be honest with you, but it's not nothing. I personally wouldn't take currency and company and country risk. For me, I would just own it in Hong Kong, transfer your shares. But if you want to own it in Germany and take the currency risk, have at it. Matt Mitchell, GNTX. The short answer is I won't be involved, because I don't think I have at least a double upside. But I think you're probably right to buy some here. A little worried about their margins continue to decline. What did they do here? Description. Digital vision, connected car, dimmable glass, and fire protection. Automatic dimming rear view mirrors. Automotive electronics, non-automatic dimming rear view. Yeah, this is not anything like Cooper Standard. Yeah, they happen to be an auto parts supplier, but this is not like indispensable stuff. Let me just take a look at the financials. If you're going to be in a commodity business, you really want to be in a commodity business and be the leader. This. Cash flow has been pretty steady. Balance sheet's pretty healthy. So you just have to really understand their products. I think what you've got here is a don't get fired from your job, easy 50% over the next couple of years. It's not going to be a home run, but it's a good quality business at a good price. And as long as you understand the product and the competitive landscape, I think you found a winner. All right. That's that, but not a home run. It's like a single. I go for doubles and triples. That's a, and every now and then home runs like Cooper, but that's a single, and it's probably a pretty sure single. Sagar, congratulations on Cooper Standard. Okay, want to know PLCE. Yeah, this thing is a chronic bag of crap. So let's see. Mythac Capital, purchase 50%. Financial support, loans over total. Yeah. I don't think this business is a good business. Let me just take a look at the financials. I mean, their revenues are collapsed. So this guy that's involved, or whoever the hell he is probably doing some type of real estate play, like all the people that got bagged in Macy's. I don't think this thing turns. There are no signs of it, unless they got some miracle turnaround plan. But I don't know that. This is the type of business that has to go through bankruptcy, wipe out the debt, and then maybe the brand is worth something. $166 million. I mean, it's not a huge amount of debt, but relative to their $5 million of cash, it is. I understand why you want to do this, because if they actually fix it, the thing goes from $5 to $50 pretty quickly. Children's specialty portfolio. Children's clothes. I don't think so. I've seen too many of these specialty retailer businesses like Chico's and all that stuff go bankrupt. Yeah, so they've got a new sugar daddy for a little while, but those guys usually get wiped too. I would pass. Ultimately, what's going to happen is those debt financiers are going to own the whole business at the end of the day and wipe out everyone subordinate to them, including the equity. Eric F. Asking about what should he do with Berkshire. We covered that in the 10 minutes with CNA. He's talking about investing with Great Hill Capital versus just buying Berkshire. Look, I have 100% of my net worth in Great Hill. I think, based on what I said, with number one, the law of large numbers. Number two, with Buffett kind of being out of the picture, I think basically owning Berkshire is going to be like owning the S&P 500. So, talk is cheap. I put my money where my mouth is, and I'll leave it at that. Dylan K. I think we've covered that multiple times before. Lee Foster, what do you think about Teradyne? It's a great company. Let's just see if it's the right time. This is not a fat pitch for me. I like your thought process, but I don't think I'm getting compensated enough for the risk. If I'm going to take risk, let me take some real risk. Let me own Intel, where my downside is pretty much protected. And if they fail, I come out flat. And if they succeed, I get a quick double. And if they really succeed and execute, like I think they can with Lip Bhutan, I wind up with a 4 to 5 bagger. That's where I want to take my risk. I don't want my risk in this, like, if I win, I'm up 50%. And if I lose, I'm down 100. Like that, I'm not willing to accept. So, because I have to size it in accordance, and it just doesn't. This is not a triple in the next 3 years. So, and it's probably not even a double. So for that reason, as much as I think the business is a good business, I just don't think there's enough juice in it for me to risk $1 of capital, even though it probably goes up, not down. Let's see here. I mean, it definitely has the runway. So you just have to get comfortable with the turnaround plan. This is not where I want to play. I think you're right. It's a pass for me, but good question. And with that said, we're done. We covered all of our questions. We'll be back next week. Maybe a day early from New York, maybe a day late from Florida, but we'll get it out to you next week for sure. I'm sure we'll have a lot of great stuff to cover. So with that said, we'll be back next week. In the meantime, make it a great one. Bye for now.